Thanks for joining me. My name is Skylar with Cedar Management, and today I'm excited to talk to you about increasing your financial leverage. So, start off with a quote from Robert Kiyosaki. He says, "The best way to build wealth is to use leverage." And most people don't know this, but Robert says the number one form of leverage is your mind, and the second form of leverage are your words. He says, increase your financial vocabulary and you increase your financial leverage. And the best part about this, words are free. So today, let's increase our financial vocabulary and our financial leverage with these real estate investing terms. So we're going to talk about gross potential income, vacancy loss, effective gross income, operating income, before tax cash flow, after tax cash flow, total return, your total return on investment based on that total return, and effective annual ROI, and then gross yield. So gross potential income. This is total rent if the property was 100% occupied and there was zero vacancy. Now, we know that's not real, so we have vacancy loss. Vacancy loss is loss of rent because of a vacancy. Super simple. It's nice to separate these things. So you want to have your gross income, and then you want to look at your vacancy loss because you can control your vacancy loss. The two best ways to minimize this vacancy loss are, one, to price the property correctly from the start. Don't start off too high. You want to price it right from the start. We found that if you price really, really high and drop your price as you go, you're going to sometimes have almost double the vacancy. And then the second thing is you want your property to be clean and neat in appearance. We go for hotel clean. You'll see in this example that the vacancy loss on this property at a 5% vacancy rate is $1,395. Right, moving on to effective gross income is gross potential income minus vacancy loss equals effective gross income. And this is the actual income or revenue you can expect from the property. In this example, we have a gross potential income of $27,900. And if we subtract our vacancy loss of $1,395, it gives us an effective gross income of $26,505. Moving on. Now we have operating income. This is sometimes referred to as net operating income, and it's your effective gross income minus operating expenses. Now, I want you to notice on operating expenses, we have property taxes as an operating expense. And that's important because we'll talk about taxes and after-tax cash flow, but property taxes are an operating expense. So your operating income is your effective gross income. In this example, it's $26,505 minus your operating expenses. In this example, that's $10,481, and that gives us an operating income of $16,024. Next, we have before tax cash flow. So before tax cash flow is money left after operating expenses and loan payments, but before income taxes. So it's basically your operating income minus your mortgage payment. And in this example, we have an operating income of $16,024, and we subtract our annual mortgage payments of $15,293 to give us an annual before tax cash flow of $731. Next, we have our after tax cash flow. Now, this is cash remaining after operating costs and loan payments and taxes, and it's akin to the investor's true take-home profit. This number could actually be more money or less money than the before tax cash flow based on how you do your taxes and how you depreciate the property. I'm not a tax professional. I kind of have this beef with people saying they're not tax professionals, so they don't want to talk about this stuff. Depreciation and how you depreciate your properties and your play into your wealth building strategy. And I really would love to talk to you about this. Taxes is going to be one of the number one expenses over your entire life. So if you want to talk to me on a very real level and say, hey, Skylar, talk to me about after-tax cash flow, I would love to talk to you about it. So please shoot me an email. It is very personal, like it's very individualized. So there's not a one size fits all, but I would love to talk to you about this. So please do email me at skylar@cedarridgemgmt.com, and we'll talk about after tax cash flow all day long. Let's move on though to the next one. So total return. We want to look at your total return like a professional investor, because if you look at just one metric, like you make your decisions just based on cash flow, you're going to pass up on deals that are good deals. But if you make your analysis based just on appreciation, you're probably going to get into some bad deals that lose you money. So looking at any one metric by itself doesn't give you an accurate picture. And that's why professional investors look at appreciation, debt pay down, and cash flow and depreciation to help them make an accurate financial move before they buy something. So because depreciation is very individual, we're just going to look at debt pay down, appreciation, and cash flow in this example. So for a 30-year horizon on this property, we have a debt pay down of $194,000. We have accumulated appreciation of $628,000. And we have an accumulated cash flow total of $324,000. So our total return on this property for 30 years is $1,147,163. I'll say that again. The total return for this property, if we held it for 30 years, would be over $1 million. So that's helpful and that's good, but it's not the total picture. We got to kind of like figure out what that means for us as a percentage, right? So that's where we get in our total return on investment. So this is a very simple ROI formula, and it's the total return divided by the initial investment equals your total ROI. So in year one, our total return is $10,250. Our initial investment for this property was $58,200. So 10,000 divided by 58,000 equals 17.6%. Now, if we hold on to this property for 30 years, our total ROI, again, just a very simple ROI formula, is the total return of $1,147,000 divided by $58,000 equals 1,971%. That's a cool number, but that number by itself isn't super helpful, right? We want to figure out what's our average return per year, because that helps us compare one investment to another investment. So the next thing to look at is effective annual ROI. And again, this is a very simple ROI formula that annualizes the ROI to show the average return on investment by year. So we're going to take that total ROI as a percentage. We're going to divide it by the number of years we held the investment, and that's going to give us our effective annual ROI. Look at year 10 for this. So we have a total ROI. We got to come up with that first. So that's $186,023 divided by $58,200, which gives us a 10-year total ROI of 320%. Then we're going to divide that 320% by 10 years, because we held on to the investment for 10 years. And that gives us an effective annual ROI of 32%. It's a very helpful number. So now you can use that effective annual ROI to compare this investment against other investments. Something to dive into. I want to keep this video kind of short, but look up the rule of 72 as an investment rule, and that tells you how long it takes your money to double. And you could use this effective annual ROI with that rule of 72 to help you do some financial planning. All right, next ratio, or the next thing to talk about, is this ratio of gross yield. So gross yield is your gross potential income divided by the total property cost. So remember, gross potential income is the rents that you would collect if the property was 100% occupied. In this example, that's $27,900. And we divide that by the total property cost. In this example, that's $242,000. And that gives us 11.5%. Now, this is helpful because it gives you how the property is going to perform irregardless of operating expenses. So Typically, as an investor, you can control your operating expenses. So if you sort a list of properties out by what you think you could buy them for and what you think their gross potential income would be, it's going to help filter down a large list of properties into a smaller list of properties. And then from those smaller lists, you can now dive into the property taxes, the insurance. What do you think maintenance is going to be? And it's the gross yield is just helpful because it helps you take this big list, make this small list, and then from that small list, you do a lot of very detailed due diligence so you can pick an investment that makes sense to make an offer on and help grow your portfolio. So don't take all of this from me, guys. I've gotten everything from reading books and taking classes and seminars. Three of the most helpful books for me are Hold, How to Find, Buy, and Rent Houses for Wealth. Super, super helpful, super easy and simple. You leave that book with a plan to implement to build your wealth. Another one is The Small and Mighty Real Estate Investor by Chad Carson. I personally think this is the best book on real estate investing out there. It takes financial planning and all of the complex investing strategies and puts them into one book that gives you a plan on, hey, this is my financial independence number. This is a real estate investing plan I can put in place to achieve that number. And this is the next action step I need to take to do that. Highly recommend reading that book. And then another gold nugget book that isn't fancy is Building Wealth One House at a Time. Phenomenal book, guys. You can't go wrong with any of these. I suggest reading all of them. I really enjoyed this. I hope you did too. Hope it brought you value. Let me know what you think. Hope this helps. If you want to talk about anything more, please shoot me an email. God bless you guys, and I will talk with you later. Take care.